Okay, hi everyone. Let's explore this problem. It's one relating to the accounting for uncollectible accounts using the allowance method, and we're going to base it on aging of receivables. Okay, so what we have is some information presented to us for Mountain Terrace Medical Center, and you can see that on the screen. And what it says is at the beginning of the quarter, this is September 30th, 2014, they gave us this accounts receivable balance and this allowance for bad debts with a credit balance. So we had 145,000 in receivables, 3,500 in bad debts is a credit balance. And then during the last quarter of 2014, the company wrote off 3 accounts. And then we're supposed to record the bad debt expense based on the aging of receivables method. And in this little schedule down here, you see how we calculate it. Now, they tell us by the end of the year, accounts receivable balance had grown from 145,000 to 165,000. Okay, and it's stratified by the aging of the various accounts. And there's the percentage that we're estimating to be uncollectible. And from there, we have some transactions to deal with. Okay, so the first requirement is to journalize the transactions. Okay, so what I've done is I've put the solution down here so that you can see what transactions we're making. Now, when we use the allowance method and we have a write-off, that means during the year we know these accounts won't get collected. What we have to do is debit the allowance account and credit accounts receivable, and then obviously have some record to which account it relates to. Okay, sometimes these are stored in a subsidiary ledger, subsidiary accounts receivable, but in this day and age, it might be just called, we store that information in a file, in a customer file, a module, goes by different terminology, given that we're using modern computerized systems these days. Okay, so we write off those accounts, right? 1,300, 900, and 700. So we credit accounts receivable for those, and we debit the allowance for bad debts. Okay, that's the first transaction that we have to deal with. Now, the second one says we have to record bad debt expense based on the aging of accounts receivable as it appears here. So I did the math in Excel off to the side. So let me change the screen so you can see that. Okay, so now I've moved off to the side. You can see I moved to the right of Excel. Before you were looking at columns A through, I don't know, about M. Now we're looking at columns H through V. And I've formatted some information here for you and repeated that aging of accounts down here so that we could have Excel do the math. And I'm not formatting this perfectly, but you sort of get the idea. They gave us how much was less than 31 days. It was 97,000, and that was the percentage we were to use. So if I do the multiplication, I'll hit the F2 here. So I take the value of what's in cell P22 times P23. So take the 97,000 times 0.3%, and that's how much we think is going to go bad of our accounts receivable balance that is stratified by how old it is. Okay, of the accounts that are 31 to 60 days old, we think 3% will go bad. And of course, I've got the same calculation. Then 30% for the 61 through 90 days, and greater than 90 is 5,950 using 35%. And then you just sum across, right? Or sum them. What's the total? And what it says is, it says we need an allowance for bad debts sitting on the balance sheet at the end of the period that will be 11,551. So now let's go up to our T accounts. We started off with 145,000. We wrote off those 3 accounts. Okay, and if I hit the F2, you can see I just typed them in, the 1,300, the 900, and the 700. So during this quarter, we credited accounts receivable. Of course, we saw that on the last transaction. We debited the allowance account. We started off with 3,500, and then we had 2,900. Now, there were other entries made, right? We could force the balance in here if we needed to, but we really don't need to because they told us the balance at the end of the year was $165,000. However, if we wanted to force it, we can certainly do that, right? We'll take, put it here, let's say, take 165 minus 145. So that's a 20,000 difference, but 2,900 was credited to it. So we want to add the 2,900 back into it. And when I put that together, we should get 22,900. Now, just to make sure that makes sense, 145 minus 2,900 plus 22,900. There's my 165. Okay, so we had other entries that increased accounts receivable by 22,900. Well, what were those entries? Obviously we would have a debit to accounts receivable and a credit to sales every time we made a sale, and then every time we collect money, there's a debit to cash and a credit to accounts receivable. Now there could be other transactions as well, but the point is these other entries isn't really critical. It's that 165 we need. Okay, now I've moved the screen one more time, and in this darker green area, I cut and pasted the entry that we would have to make. Now, we calculated that the allowance balance has to be $11,551. So you may be wondering, why am I debiting bad debt expense for $10,951 and crediting the allowance? Well, here's why. If you look up at the T account here, we started out with $3,500. We debited $2,900 for the last quarter, right? And we've got to get to an ending balance of $11,551. That's, when we use a balance sheet approach, meaning percentage of receivables approach to calculate the allowance account, we are calculating what that ending balance should be. So we calculated 1151. That's what it has to be. Therefore, to force this to equal 11,551, then we have to force that, make an entry for $10,951. Okay, and that's where we came up with that. So hopefully this explains how the entry got there. Okay, now once again I've moved the screen, and now I want to tackle part 3, right? We journalized the transactions. We created T accounts so that we could see allowance for bad debts and accounts receivable to see how those were impacted. And we came up with what the dollar amount of allowance for bad debts needed to be. It was the $11,551. So the last step is just to show what would accounts receivable look like on the balance sheet. And you see it here. We would show accounts receivable equal to $165,000 because that's what they gave us, less the allowance for bad debt. That was that $11,551 we had to calculate. So the net accounts receivable is $153,449. Now, some people might call that accounts receivable at its net realizable value. Okay, and that's this problem, everyone. So I hope you found this to be beneficial.